Chapter 17, Government Expenditure, Revenue and Expenditure. So, a balanced budget, as you can see here in the picture with the balance here, it says expenditure is equal to revenue. So therefore, with a balanced budget is when planned revenue and planned expenditure are equal. This happens when they're both at the same level. Having a balanced budget means that there is no need to borrow money or worry about servicing the national debt. A surplus budget, as you can see in the picture on the right here, is when revenue is larger than expenditure. So the amount of money the government is receiving through taxes of people is larger than the amount that they're paying out. Planning for a surplus budget is acceptable if the government wants to reduce or to pay off the national debt. They can do this with the excess money that they have collected with the amount of people working and paying their taxes. This is obviously a good position to be in because the country is in a good financial position. More people are working, they're contributing to the economy, they're paying their taxes as they're working, paying as they earn, PAYE. A deficit budget then, on the other hand, on this picture here, you can see where expenditure is larger than revenue. So therefore the government is planning less and having less revenue and paying out more. So planning for a deficit budget is usually undertaken to stimulate the economy, to put more money into the economy rather than taking money out of the economy. So the government introduced taxation. So what is taxation? Well, taxation revenue makes up the first part of government revenue. Tax is the amount of money that the government collects through people working, to keep the company, keep the government ticking over. Revenue, all this income is received from various taxes imposed. So income tax, pay as you earn. So as you earn money, you have to, by law, pay taxes. So if you show employment or wage rates as rising, so the more people that are working, the more taxes that the government receives. So then VAT, so value added tax. So what the government does then is it imposes taxes on the goods and services within the country. So corporation tax then is the tax that the government gets from the company's profits at the end of the trading period. Excise duty shows the amount of people that are spending money on alcoholic drinks, cigarettes and motor fuel. All those are heavily taxed on as well. Then the level of stamp duty. This is not a tax on stamps. Stamp duty is a tax on the amount of land and buildings that have been purchased. You will pay a percentage amount of that to the government for those sales. Excise duty shows the amount of people that are spending on alcoholic drinks, cigarettes, and motor fuel. So what they do is they highly tax the drinks, and the motor and the fuel and stamp duty, in order to discourage that amount of expenditure. So it's taxed accordingly. Property tax then, this was brought in 2013, where people have to pay taxes on the buildings that they own. The level of capital acquisitions tax, this shows the amount of money being transferred between people. So you have to, if you inherit X amount of money, you will have to pay tax on it if it's over a threshold. The level of custom taxes then shows the level of import from non-EU countries. The Irish businesses would be concerned if there was a large amount of tax revenue came from customs duties, as this would mean that the country is importing more than it's exporting, and that would not be good for the country economically. The fact that Ireland has a very low corporation tax level. Corporation tax is the amount of taxes that the Irish companies have to pay to the government, and this is only at 12.5%. So it's extremely low compared to our European counterparts. So the UK is 20% corporation tax, in France is 34%, and in Germany is 29.68%. So it's a bit of a no-brainer really why companies are attracted to Ireland. It is because of our low corporation rate of 12.5%. Ireland then is a narrow tax base. This means that it gives the total amount of assets or revenue that the government can take is quite limited, and the government is always looking for some new way to widen the tax base, and this is why they introduced a property tax in 2013. Non-tax revenue includes the income from the government from sources other than taxation. So example would be loans to banks, licenses, TV licenses, dog licenses, passports, and the plastic bag levy. So these are all extra little bits, nooks and crannies how the government can get extra money out of us. Then the government current expenditure, this is the day-to-day spending on every day the government has. So paying the salaries of teachers, nurses, doctors, army personnel, and social protection. And this also covers the equipment and the materials used by the public servants on a day-to-day basis. Then in relation to the capital spending is the long-term investment, the long-term spending on roads, infrastructure, spending on schools, hospitals, prisons. So it is acceptable for the government to spend vast amounts of money on long-term assets. It is seen that it will have long-term value, and all people will benefit from this expenditure in the long run. Thank you.